debt has accompanied humanity since its first organized steps. It is not a modern phenomenon nor exclusive to financial markets, but an invisible thread that unites civilizations, empires, and nations. Every loan, every broken commitment, has left scars in history, reminding us that trust cannot be printed or bought. Since ancient times, borrowed money has been a silent weapon, and sometimes a trigger for chaos. Debt, when it becomes a default, reveals more about human nature than any philosophical or historical treatise. It is a mirror of the power, fear, and ambition that drives men and states. The first known default was not an act of contempt, but of survival. The Greeks, faced with wars and external pressures, discovered that debt can crush even the proudest cities. Since then, defaults have marked shifts in power, accelerated revolutions, and toppled empires. Every default has a story that goes beyond numbers. It reflects the fragility of human agreements and the speed with which trust can crumble. When a state defaults, it is not just breaching a financial contract. It is sending a silent message about its limits and vulnerability. Spain, France, Russia, Argentina. Each case has its own unique characteristics, but they all share a common pattern: excess, lack of foresight, and the pressure of unsustainable expectations. Defaults are not mere accounting accidents, but turning points that transform societies, economies, and international relations. Observing the history of defaults, we understand that debt is also a language. It speaks of lost trust, broken promises, and a nation's ability to keep its word to the world. Each default leaves invisible lessons that only attentive observers can perceive. The relationship between wealth and power has never been linear. Sometimes abundance brings security, other times it increases vulnerability. Debt transforms people and nations. It grants them authority and, at the same time, binds them to commitments that may prove unsustainable. Default, then, is not just an economic failure, but an ethical and social revelation. It shows where power really lies, not in banknotes or reserves, but in the faith others place in them. Over the centuries, humanity has oscillated between expansion and collapse, between blind trust and utter distrust. Defaults act as catalysts, accelerating changes that would otherwise have occurred slowly. Every default is a breaking point, a moment when existing structures are tested and where an opportunity arises to rebuild, to redefine what it means to govern and trade. Debt, then, is not just a number, but a mirror that reflects the human condition. And so, as we contemplate the stories of Greece, Spain, France, Russia, and Argentina, a fundamental fact comes to mind. Defaults are part of an eternal pattern. Humanity repeats its mistakes, but it also learns, sometimes too late. Debt and its defaults are not isolated tragedies. They are chapters in an ongoing tale of ambition, greed, and the fragility of trust. To hear these stories is also to hear a reminder. All power depends on the faith others place in it. Each default not only changes a country's destiny, but leaves a shadow that influences neighbors, allies, and rivals. International markets are mirrors that reflect the fears and hopes of every nation. History teaches us that defaults create ripples, altering relationships, imposing new rules, and sometimes generating revolutions. And by listening to these echoes, the listener begins to understand that debt is more than a contract. It is an invisible bond that connects everyone. Default makes no distinction between empires or republics, between monarchies or democracies. All are subject to the same law. Lost trust is devastating, and recovery requires time, discipline, and fortune. The history of default shows that no power is absolute, and that no wealth guarantees immunity from the pressure of unfulfilled commitments. Every outstanding debt is a silent reminder of our limitations, both individual and collective. Today, as we listen to these stories, we can see parallels with the present day. Argentina, some emerging countries, and even powerful economies show signs that history tends to repeat itself. Each past default offers lessons that could prevent future collapses, but humanity seems captive to the same patterns of ambition, excess, and carelessness. Listening to and reflecting on these historical episodes is essential to understanding the fragility of global financial stability. Finally, this introduction invites the listener to contemplate not only the defaults of the past, but the very nature of debt. Defaults are not individual failures, but manifestations of a collective phenomenon that spans centuries. They are reminders that trust is more valuable than gold, more powerful than any army, and more fragile than human ambition itself. And as we delve into the history of these defaults, the listener understands that default is not an end, but a mirror that reveals the truth of our decisions and the power we think we control. Chapter 1. Ancient Greece. The first known default. Ancient Greece shows us that debt and defaults are not modern inventions. In the polis, city-states faced constant wars, fragile alliances, and growing financial needs. To sustain their armies and fortifications, they lent resources, accumulated commitments, and created obligations that sometimes exceeded their actual ability to pay. Thus was born the first documented default, a non-payment that not only affected the economy, but also destabilized the political and social structure of the time. What seemed like a financial problem became a catalyst for deeper changes, where loyalty, trust, and authority were put to the test. The city-states learned that default not only generates resentment, but redefines relationships, alliances, and hierarchies. Default in ancient Greece was not only an act of economic incapacity, but also an act of political decision. Choosing not to pay on time was a strategy, protecting one's own resources, prioritizing the maintenance of the army, or ensuring internal survival. However, this decision had an immediate cost: the distrust of allies, the enmity of lenders, and the weakening of the city's reputation. Economics and politics were inextricably linked, and default showed how fragile human structures could be in the face of financial pressure. Society also paid its price. Citizens faced higher taxes, confiscations, and in some cases, the loss of civil rights or privileges. Internal conflicts intensified, and leaders were challenged by those who questioned debt management. Each default was a reminder that stability does not depend on gold or silver alone, but on collective trust in those who manage the resources. Yet Greek history also shows the resilience of trust. After default, cities rebuilt relationships, renegotiated debts, and re-established commitments. They learned to balance ambition with prudence and to value credibility as much as tangible wealth. The default was not an absolute end, but a cycle of learning and adjustment that anticipated patterns still present in the global economy today. Historians point out that this first default had repercussions beyond the economy. It changed the way city-states negotiated alliances, established pacts, and maintained armies. Debt became an instrument of power, but also a reminder of human limitations. Trust, once broken, needed gestures, time, and evidence of goodwill to be restored. In cultural terms, the Greek default left its mark on philosophy and literature. Thinkers began to reflect on justice, fairness, and responsibility. They understood that money is not neutral. It is a reflection of human relationships and the power that some exercise over others. Economic history is intertwined with ethics, and ancient defaults show that numbers do not exist without moral consequences. Greek learning also extended to commerce. merchants and lenders carefully evaluated who they lent to, when, and under what conditions. Reputation became capital, and defaults left visible scars on the credibility of a city or individual. Every financial decision was, in effect, a political and social act, fraught with risks that transcended the balance sheet. The effects of default were felt long-term. Military alliances could change, trade contracts were renegotiated, and war strategies were adjusted based on actual payment capacity. Debt, then, was a determining factor in the very survival of the city-state. And while some cities fell, others learned to better manage their resources and their mutual trust. This chapter on Greece reminds us that defaults are neither contemporary nor isolated phenomena. They are part of a universal human cycle. The creation of compromises, the tension between ambition and ability, and the collapse of expectations. Money, although tangible, is always tied to perception and collective faith. And when that faith is broken, even the purest gold cannot sustain the illusion of stability. Finally, the first Greek default teaches a lesson that resonates to this day. Debt not only drives economies, but also shapes societies, politics, and cultures. Understanding the history of these defaults is to understand the fragility of trust and the repetition of patterns that span centuries. The listener must perceive that the history of defaults is not a tale of failure, but a guide to understanding how power and money are always intertwined. Chapter 2: Spain and the Bankruptcies of the Austrians. 16th and 17th century Spain was the first modern global superpower. Its wealth seemed endless, flowing from the mines of the Americas, laden with silver and gold that filled royal coffers and the world's imagination. But beneath the glitter of the metals lay a fragile reality: mounting debt, rampant inflation, and the illusion of absolute economic power. The crown spent without measure on continental wars, defending far-flung territories and flaunting its power, confident that the steady flow of silver would sustain its ambitions. However, the empire's finances began to show cracks, and banks and lenders soon discovered that gold and silver do not guarantee solvency if expenses exceed income. The Spanish Habsburgs declared bankruptcy on several occasions, a phenomenon that surprised Europe and alarmed merchants. Each default was not just a non-payment. It was an economic earthquake that affected trade routes, product prices, and faith in the empire. Foreign merchants hesitated to lend, inflation devoured wages, and the prices of basic goods soared. Thus, the wealth that had seemed endless became a mirage, and the greatness of the empire began to depend more on reputation than on royal treasures. The effect of these defaults extended beyond the economy. Confidence in the crown and the administration of the empire slowly eroded. Nobles, officials, and citizens began to question the ruler's ability to manage wealth and maintain stability. Each default generated a domino effect: renegotiated debts, new loans with higher rates, and an increasingly burdensome bureaucracy seeking to prop up an already exhausted system. Inflation was the silent price of excess. The abundance of precious metals seemed like a gift, but it soon became a curse. Prices rose, wages fell short, and the domestic economy suffered as military spending and international diplomacy drained the national treasury. Silver, which should have symbolized power, became a constant reminder of the fragility of wealth. Every bankruptcy had its story and its excuses: endless wars, rebellions, maintaining distant colonies, courtly luxury. But at its core, there was always the same cause: a lack of planning and dependence on external resources. The lesson was clear. Abundant wealth is not synonymous with financial stability, and an empire that spends more than it produces is headed straight for decadence. The history of Spain is a mirror for any nation that blindly trusts in its economic power without measuring the risks or consequences. International markets viewed each bankruptcy as both a spectacle and a warning. Merchants in Genoa, Antwerp, and London learned to diversify risks, demand collateral, and assess the crown's reputation before investing. Politics and economics were inextricably intertwined, and Spain's insolvency demonstrated that military and territorial power do not guarantee financial solvency. Each default was a reminder that the economy follows invisible rules, and that trust is more valuable than gold itself. The decline of the Spanish Habsburgs was not sudden, but gradual and almost inevitable. The accumulation of debt, excessive military spending, and dependence on the flow of silver created a vicious cycle. More silver, more spending, more spending, more debt, more debt, more defaults. Each bankruptcy weakened the empire's perception of power, and with each default, Europe learned not to blindly trust Madrid's apparent wealth. Thus, financial history mingled with the politics, diplomacy, and culture of an empire that still fascinated the world. Historians emphasize that Spain's bankruptcies teach lessons that transcend centuries. Debt management, financial prudence, and transparency become essential to sustaining any prolonged power. Each default not only showed the fragility of an empire, but also revealed universal human patterns: ambition, greed, and the illusion of unlimited wealth. Spanish history is a mirror that anticipates future crises and silent warnings for those who believe that monetary power is eternal. Finally, the bankruptcies of the Habsburgs remind us that money is more than metal or banknotes. It is a reflection of trust, collective perception, and the balance between desire and reality. Spain's history teaches us that wealth is not measured solely in gold, but in the ability to sustain and manage it wisely. And that even the most powerful empires can fall when they forget that stability is not a luxury, but a responsibility. Chapter 3. France before the Revolution. France in the late 18th century was a nation of extreme contrasts. Glittering palaces and manicured gardens coexisted with impoverished villages and peasants eking out an existence under unbearable taxes. The monarchy, led by Louis XVI, spent recklessly on luxury, war, and court ostentation. Meanwhile, the public debt grew by leaps and bounds, fueled by foreign loans that financed armies, palaces, and aristocratic life. Every banknote issued seemed like a promise of stability, but in reality, it was a burden that future generations would pay for with interest and blood. The royal treasury was depleted long before the problems became apparent to the population. Ministers proposed tax reforms, but the privileged estate, the nobility, and the clergy refused to contribute proportionally. The pressure on the peasants and the urban bourgeoisie intensified, and the gap between wealth and need widened dangerously. Every attempt to balance the books met with resistance from those who enjoyed hereditary privilege. The debt was not just a number on the books. It was a system that fueled silently accumulating social and political tensions. Continuous borrowing was necessary to maintain the facade of power and magnificence. European bankers and lenders demanded collateral, and the monarchy promised payments it could not keep. The insolvency was evident to experts, but the common population only perceived rising prices and the tax burden. Food prices rose, taxes multiplied, and distrust of the crown grew like a silent fire that no one could extinguish. The lavish spending wasn't limited to luxury. The wars, especially participation in the American independence movement, drained vast sums of money. France had supported a noble cause, but the price was catastrophic. Billions in debt the kingdom couldn't sustain. The perception of power and honor masked a financial fragility that would soon become unsustainable. Every shipment of silver, every loan taken out, increased the burden on a system on the brink of collapse. The bourgeoisie, which financed part of these loans and suffered taxes, began to question the legitimacy of the existing order. The nobles enjoyed privileges, and the monarchy ignored the growing pressure from those who produced the royal wealth. This economic inequality created a breeding ground for discontent, and confidence in the stability of the kingdom eroded daily. Money, which was supposed to symbolize security, became a constant reminder of the fragility and corruption of the system. Financial experts warned of imminent danger, but political decisions continued to prioritize appearance over solvency. The deficit grew, and each fiscal reform was insufficient compared to the magnitude of the accumulated debt. Social pressure mixed with economic strain, and the gap between the elite and the people reached unsustainable levels. France found itself trapped in a cycle that repeated the history of indebted empires: apparent wealth, excessive spending, inability to pay. The population began to organize, discuss, and question the authority of the crown. Markets moved with uncertainty, prices fluctuated, and confidence in state-issued money began to waver. The debt was not just an accounting problem, it was a trigger for social and political revolution. Each future default announced that traditional institutions could no longer sustain the stability they had once offered. The history of France before 1789 demonstrates how insolvency can precede radical change. The kingdom's defaults and the monarchy's inability to manage resources created the conditions for an unprecedented uprising. Faith in money mixed with faith in authority, and when one fails, the other fails as well. The French Revolution did not emerge in a vacuum. It was the direct consequence of centuries of financial mismanagement and systematic inequality. Finally, the French chapter teaches an eternal lesson. Money is more than numbers. It is trust, balance, and collective perception. When debt exceeds the ability to pay and the population loses faith, the most solid systems collapse. The history of France is a reminder that economic stability is only as fragile as the trust that sustains it, and that default can trigger changes that transform entire societies. The revolution was, in essence, the inevitable consequence of a historic default in people's faith. Chapter 4: Russia in 1917, the fall of Tsarism. Russia at the beginning of the 20th century was a vast and unequal empire, where wealth was concentrated in the hands of a few, and the majority lived in extreme poverty. Agriculture, the foundation of the economy, was backward, and peasants were burdened with taxes that financed endless wars and the luxury of the Tsarist court. The First World War exacerbated the situation. Military costs drained state reserves and forced Tsar Nicholas II to take out massive loans from foreign banks. Foreign debt grew to unsustainable levels, and each ruble issued seemed more like a promise than a real value. Meanwhile, internal tensions multiplied. Striking workers, impoverished peasants, and war-weary soldiers began to question the authority of a regime that seemed unable to sustain itself. Money, currency, and debt were no longer abstract concepts. They were symbols of a system that failed to protect its population. The lack of effective payments and the inability to finance society's basic needs undermined faith in Tsarism, creating a breeding ground for radical change. Foreign loans, which initially sustained the state machinery, became shackles. Western bankers demanded guarantees and payments that Russia could not meet, and the country's financial dependence became evident. Every attempt by the Tsar to stabilize the economy failed in the face of rising inflation and food shortages. The population felt that its future was mortgaged to debt and the whims of distant elites, and confidence crumbled by the day. The Russian default was more than an accounting problem. It was the spark that ignited radical political change. The February Revolution of 1917 did not emerge from nowhere. It was the result of decades of financial and social mismanagement, intensified by the unaffordable demands of war. The fall of Tsarism highlighted how debt and the inability to meet obligations can precipitate the collapse of centuries-old institutions. Politics and economics were so intertwined that a financial default became a revolutionary catalyst. The October Revolution and the rise of the Bolsheviks transformed Russia's economic structure. Foreign debts were repudiated, banks confiscated, and the economy nationalized in an attempt to rebuild trust from the ground up. What had once been credit and promise was now replaced by direct state control, a radical experiment in monetary history. The lesson was clear. When a system fails to sustain the trust of its population, even the largest empires can crumble. The Russian default had immediate geopolitical effects. International allies and adversaries saw the collapse of a traditional empire, and the global equilibrium was shaken. The instability fostered new tensions and raised questions about the sustainability of financial systems, dependent on trust and debt. Each nation watched, learned, and reconsidered how its own economy could withstand similar shocks. Internally, Russian society also changed forever. Peasants seized land, workers took over factories, and the idea that wealth could be controlled by a few lost legitimacy. Debt, once a symbol of prestige and power, became a catalyst for social and political transformation. The lesson for the world was clear. Default doesn't just affect banks, it affects the very structure of a nation. The Russian case demonstrates that faith in a financial and political system are always intertwined. When debt becomes unpayable, the system falters, and the illusion of stability is shattered. Money that cannot support the real needs of the people loses its value faster than any precious metal. And in that vacuum, change emerges, sometimes violent, sometimes radically transformative. Finally, the fall of Tsarism teaches us that historic defaults are not just accounting errors, but warnings about the power of debt and trust. They are reminders that even the greatest empires can crumble when financial fundamentals fail. Russia's 1917 story remains an example of how insolvency can trigger revolutions, reconfigure societies, and change the course of world history. Faith in money and political structure is always at stake, and when it fails, nothing remains the same. Chapter 5: Argentina. The repetition of modern history. Argentina is a country marked by financial cycles that repeat themselves like echoes of the past. Since its independence, the Argentine economy has oscillated between boom and bust, with episodes of debt that have marked entire generations. Foreign debt, inflation, and broken promises have created a seemingly immutable pattern. Temporary prosperity followed by inevitable collapse. Each default is not just a financial event, but a reflection of the political and social decisions that precede it. The first modern defaults began in the 19th century, when the country was emerging as an agricultural producer and seeking financing for infrastructure and development. Foreign loans came with strict conditions, and overconfidence in the booming markets led to over-indebtedness. When revenues fell short of meeting commitments, the economy faltered, and the faith of foreign investors crumbled. History repeats itself. Debt becomes a weapon of pressure, and the population pays with reduced purchasing power and loss of confidence. During the 20th century, Argentina experienced several defaults that marked milestones in the global economy. In 2001, the country reached one of its most dramatic episodes. The accumulated debt became unpayable, banks closed, and millions of citizens lost their life savings. The crisis was not only financial, but also social and political. Protests, changes of government, and a general sense of betrayal accompanied the default. The pattern was clear: excessive expansion, growing debt, inability to pay, and collapse of the financial system. Each Argentine default is also a lesson in the fragility of international trust. External creditors adjust conditions, raise interest rates, and are wary of new agreements. The country's reputation is tarnished for decades, and each attempt to re-enter international markets requires patience, reforms, and rebuilding faith in solvency. However, history shows that, despite historical memory, cycles tend to repeat themselves when fiscal discipline and strategic planning are neglected. The internal impact is also profound. The population feels the volatility firsthand. Inflation, unemployment, and loss of savings combine to generate widespread distrust in institutions. Defaults affect entire generations, leaving their mark on financial education, consumer behavior, and the perception of economic security. Each crisis reinforces the idea that wealth and stability are temporary, and that the monetary system is subject to forces far greater than individual will. The pattern of repetition is surprisingly consistent. Increased public spending, excessive external financing, crisis of confidence, default, and restructuring, a cycle that repeats itself with slight variations in historical context. What is remarkable is how Argentine society and economy managed to adapt after each crisis, learning, adjusting policies, and waiting for a new cycle of stability before the next collapse. Resilience and vulnerability coexist in every financial chapter of the country. Argentine defaults also highlight the interplay between politics and economics. Government decisions affect international perceptions and financing capacity, while debt cycles influence domestic policies. Each default is, in part, the result of a delicate balance between campaign promises, social needs, and creditor pressure. When this balance is upset, the country pays with economic collapse and social unrest. From a historical perspective, Argentina becomes a unique case study in how defaults can shape a country's trajectory. It's not just about numbers and balance sheets. Each default transforms institutions, alters trust, and reconfigures the relationship between citizens and the state. Defaults show that debt is not abstract. It is a factor that shapes daily life, politics, and the economic future of an entire nation. Argentine history teaches us that the lesson of unpaid debt is learned the hard way, time and again. Finally, when looking to the future, the inevitable question arises: who will be the next big global default? Historical patterns, such as those seen in Argentina, Greece, Spain, or Russia, offer clues and warnings. The combination of excessive debt, fragile confidence, and reckless policies can repeat financial tragedies anywhere in the world. History reminds us that debt is not just a number on a ledger. It is a force capable of transforming entire societies. Chapter 6: Predictions and the Next Big Global Default. Today's world is more interconnected than ever, and debt is no longer a problem isolated to one country, but a global network that can send shockwaves across every continent. Sovereign risks are intertwined with financial markets, monetary policies, and international investor confidence. A default today would not be a local event, but a phenomenon capable of impacting entire economies, supply chains, and global political stability. Every country with unsustainable debt levels, fiscal imbalances, or external vulnerabilities becomes a potential weak link in this chain. Historical comparison is inevitable. Greece in antiquity, Spain under the Austrians, France before the Revolution, Russia in 1917, and Argentina in recent centuries all display a consistent pattern: expanding debt, loss of confidence, and inevitable collapse. Today, many countries display figures reminiscent of those episodes: growing deficits, runaway public spending, and dependence on external financing. However, globalization adds a new layer. A default can trigger crises in distant markets, affecting currencies, stocks, and bonds almost immediately. Among the most exposed countries, some stand out for their dollar-denominated debt, unsustainable interest rates, or chronic fiscal deficits. The combination of external debt and political vulnerability increases the likelihood of sudden defaults. Others, with strong reserves and prudent policies, show resilience, but even they are not completely immune to global shocks or the financial collapse of their trading partners. Global interdependence makes each economy a mirror of collective risk. Key economic indicators are becoming essential for predicting potential defaults. Fiscal deficit, debt to GDP, international reserves, inflation, and the trade balance are all signals that analysts closely monitor. However, as history shows, there is no absolute certainty. Political, social, and psychological factors can accelerate a collapse or prolong apparent stability. Debt is as much about mathematics as it is about perception. When trust is broken, numbers lose their meaning. Beyond the numbers, the geopolitical context matters. Sanctions, trade conflicts, wars, and changes in investment patterns can dramatically alter a country's ability to meet its obligations. Even solid economies can find themselves trapped in crises if they become isolated from the global financial system or lose access to external capital. Debt is no longer just an economic problem. It is a tool of influence and power, capable of shaping political decisions and international strategies. The behavior of financial markets also reflects anxiety about future defaults. Unusually high bond yields, currency volatility, and massive capital movements are early signs that risk perceptions are changing. The experience of Argentina, Greece, and other countries shows that when investors lose confidence, access to credit is abruptly reduced and the crisis accelerates. Collective psychology becomes an accelerator of default, sometimes faster than any underlying structural problem. At the global level, the debt of the largest countries also raises questions. The United States, China, Japan, and the Eurozone handle astronomical amounts that could trigger crises if combined with unexpected shocks. Financial interdependence means that a partial default in one country could generate a domino effect, affecting banks, investment funds, and entire economies in real time. No one is completely isolated. The debt prison is global. In this context, experts warn of an uncertain future and the possibility of a massive global default. The question is not only who will fall first, but when and under what circumstances. Financial technologies, derivatives, and the expansion of electronic credit further complicate prediction. What was once measured in physical currencies now circulates as digital promises, increasing the fragility of the system. The historical lesson is clear. Defaults don't happen in a vacuum. They arise from a combination of excessive debt, mismanagement, eroded confidence, and external factors acting as catalysts. Each country has its own threshold, but the logic is universal. Learning from past mistakes can offer time for prevention, though never absolute certainty. Ultimately, the listener becomes a witness to this repeating history. Debt and defaults are part of human dynamics, a mix of trust, greed, and collective destiny. As we look at balance sheets, bonds, and indicators, the question remains: who will be the next to succumb? And while we can't predict exactly, the pattern is there, waiting to repeat the centuries-old history. Final reflection: learning from collapse. Looking at the history of defaults is like holding a mirror to our own vulnerability. Each default reveals the tension between power, ambition, and collective confidence. Greece, Spain, France, Russia, and Argentina show that debt is not just a number, but a reflection of human choices, mistakes, and excesses. Each default leaves lessons that, if ignored, are destined to be repeated. The listener, at this point, becomes a witness to cycles that transcend centuries. This isn't just about politics or economics, but about psychology, perception, and risk perception. The fragility of trust is as tangible as the empires crumbling around it. Debt is a silent catalyst that can accelerate change while simultaneously exposing a society's resilience or weakness. Learning from collapse involves observing patterns: excessive expansion, uncontrolled spending, and dependence on external credit. Every historical default follows a similar script, although the protagonists and scenarios change. Humanity seems trapped in a constant repetition of confidence and disillusionment. And each crisis leaves scars on the economy, politics, and collective memory. Empires that fell due to default also show that absolute power does not guarantee stability. The accumulation of wealth and boundless ambition often precede collapse. Debt acts as a mirror, reflecting how far a government, a financial system, or a society can stretch before breaking. To ignore these signs is to invite the next default, wherever it may occur. The pattern repeats itself. When trust disappears, the economy seizes up, markets fall, and governments face the harsh reality of their commitments. Citizens suffer, institutions transform, and the victors and vanquished switch places. Each default is a reminder that debt is a tool of power, but also a double-edged sword. Stability is fragile, and constant vigilance is the only real defense. Beyond the economy, defaults show humanity's vulnerability to its own choices. Ambition, greed, and the illusion of control drive entire societies to the brink of collapse. Understanding this allows us to anticipate risks, but also to recognize that cycles are part of our collective nature. Debt is ultimately a mirror of human character, with its strengths and weaknesses. The listener should remember that defaults don't just destroy economies, they transform societies. They change governments, generate revolutions, and alter the distribution of power. Each default creates opportunities for some and devastating losses for others. The history of debt is the history of resilience and human fragility intertwined. Learning from these collapses means recognizing that risk isn't abstract, but real and tangible. It's not just about studying numbers and balance sheets. It's about understanding the psychology behind trust. Empires fall, markets tremble, and societies adapt, always within this endless cycle. Default, in this sense, is a silent teacher, teaching without words, but with inescapable results. Ultimately, the pattern persists. Debt changes face, currencies fluctuate, governments and banks evolve, but the lesson remains. Excess, ambition, and confidence are the formula for fragility. Defaults are inevitable, but they are also sources of learning and transformation. The listener, aware of this, observes the story with fresh eyes, understanding that each collapse is also an opportunity for reflection. And so concludes our journey through historical defaults. Debt spans the centuries as a thread of human ambition and fragility. What changes are the names, the countries, and the settings. What remains is the pattern. Learning from the past is preparing for the future, remembering that defaults change empires, but human nature and its cycles never disappear. Final reflection: learning from collapse. Looking at the history of defaults is like holding a mirror to our own vulnerability. Each default reveals the tension between power, ambition, and collective confidence. Greece, Spain, France, Russia, and Argentina show that debt is not just a number, but a reflection of human choices, mistakes, and excesses. Each default leaves lessons that, if ignored, are destined to be repeated. The listener, at this point, becomes a witness to cycles that transcend centuries. This isn't just about politics or economics, but about psychology, perception, and risk perception. The fragility of trust is as tangible as the empires crumbling around it. Debt is a silent catalyst that can accelerate change while simultaneously exposing a society's resilience or weakness. Learning from collapse involves observing patterns: excessive expansion, uncontrolled spending, and dependence on external credit. Every historical default follows a similar script, although the protagonists and scenarios change. Humanity seems trapped in a constant repetition of confidence and disillusionment. And each crisis leaves scars on the economy, politics, and collective memory. Empires that fell due to default also show that absolute power does not guarantee stability. The accumulation of wealth and boundless ambition often precede collapse. Debt acts as a mirror, reflecting how far a government, a financial system, or a society can stretch before breaking. To ignore these signs is to invite the next default, wherever it may occur. The pattern repeats itself. When trust disappears, the economy seizes up, markets fall, and governments face the harsh reality of their commitments. Citizens suffer, institutions transform, and the victors and vanquished switch places. Each default is a reminder that debt is a tool of power, but also a double-edged sword. Stability is fragile, and constant vigilance is the only real defense. Beyond the economy, defaults show humanity's vulnerability to its own choices. Ambition, greed, and the illusion of control drive entire societies to the brink of collapse. Understanding this allows us to anticipate risks, but also to recognize that cycles are part of our collective nature. Debt is ultimately a mirror of human character, with its strengths and weaknesses. The listener should remember that defaults don't just destroy economies, they transform societies. They change governments, generate revolutions, and alter the distribution of power. Each default creates opportunities for some and devastating losses for others. The history of debt is the history of resilience and human fragility intertwined. Learning from these collapses means recognizing that risk isn't abstract, but real and tangible. It's not just about studying numbers and balance sheets. It's about understanding the psychology behind trust. Empires fall, markets tremble, and societies adapt, always within this endless cycle. Default, in this sense, is a silent teacher, teaching without words, but with inescapable results. Ultimately, the pattern persists. Debt changes face, currencies fluctuate, governments and banks evolve, but the lesson remains. Excess, ambition, and confidence are the formula for fragility. Defaults are inevitable, but they are also sources of learning and transformation. The listener, aware of this, observes the story with fresh eyes, understanding that each collapse is also an opportunity for reflection. And so concludes our journey through historical defaults. Debt spans the centuries as a thread of human ambition and fragility. What changes are the names, the countries, and the settings. What remains is the pattern. Learning from the past is preparing for the future, remembering that defaults change empires, but human nature and its cycles never disappear.